Hello, everyone, and welcome to Pearls of Fisdom with Nirmal. I'm Avan Dabash. Let's put the spotlight on Gulf Oil Lubricants. It's a division of the Hinduja Group, one of the largest independent players in the downstream lubricants industry. They've established themselves as a global frontrunner in propelling industries worldwide. It's an extensive portfolio that covers automotive and engine oils, gear and marine oils, as well as hydraulic oils. It's clearly serving a vast spectrum of sectors. So let's understand the impact of crude oil price volatility, the outlook on margins, volume growth, financials, and so much more. Manish Gangwal is the CFO and now joins us. Thank you so much for taking time out. So let's talk about the crude oil price movement, the fact that we have seen a depreciating rupee to add to that. All of that could really exert pressure on your margins. So give us a sense as to how these variables are playing out on your margins, given that you've been able to mitigate the margin pressures so far.
Yeah, first of all, thank you for having me on your show. Yes, you are right. Crude has been sort of volatile, but still within a range. It has not broken the outside ranges on either side. So, which is we in our terminology of lubricant, we treat as more or less stable as long as it is within the band, and that's what crude has been behaving. So, crude wise we are okay, but anyway, the crude has an impact on base oil, which is our key raw material, with a lag effect of 1 to 2 months, and we get during that period enough time to sort of recalibrate our margins. Rupee depreciation has been a key area of concern or bother for us, but what we have seen also is that there is some stability now coming back in the last few days, and it has, after touching a low of 88, it has sort of now below 87 again, which is again somewhat a respite. But having said that, we as a company have been always focused on margin management effectively, and these impacts of crude or rupee, if they are sustainable over a long period, then we are in a position to pass on those impacts to the customer consumer. We take price increases in our retail segment, and in our OEM businesses, there are price variation clauses on quarterly basis which we are in a position to either pass on or pass back, whatever way the movements are. So, yeah, I would say margin-wise, we have been able to effectively manage our margins over the last many years. If these volatilities remain, we will take margin actions at our end.
So let's talk about your plans as well to double the growth rate, particularly for your premium products. That is something that you've been looking at very closely. What's the game plan?
Yeah, so India as a market, is also maturing. As we have seen in the European world and in the Western world, there are a lot of synthetic products which have come up over the last decade, and India in a way follows that trajectory. So we are here in India also. We are seeing a lot of advanced products, long grain products, where Gulf has been a pioneer in launching long grain products in India. Plus, a lot of synthetic, semi-synthetic products are also coming in, which gives an opportunity to add value more than volume. And we are working on such products, high-end products, or semi-synthetic, synthetic products, what we internally call premium products, in both mineral and synthetic segment, based on margin profile, and pushing those products in our portfolio. We are educating our customers also on the benefits of those products, so that the customers are convinced on buying these premium products, which gives them value and creates a win-win. And that's segment by segment, including in our B2C plus in the industrial segment, we are clearly focusing on improving our sales mix towards product mix towards these premium products. So that has been a clear internal target to our sales and marketing team as well.
There's been the recent extension of the strategic partnership with Piaggio Vehicles until 2030. What would be the incremental revenues from this?
So we have been with OEMs like Piaggio for a long time now. Already for the last 4 or 5 years, we are their exclusive supplier of lubricants. What we have done is that we have extended that partnership now for another 5 or 6 years. So it gives stability to the volume, and then of course, based on their growth plans, we are looking forward to our growth plans also in the OEM businesses. Our volumes and growth is linked to how OEM is becoming aggressive and how they want to grow, and based on that, we sort of follow them in their markets. We supply lubricants to their some of them for factory fields, some of them for their workshops, franchisee workshops, where our dealerships, what we call. And then in the aftermarket also, we launch products with them, co-branded products, or they endorse our products. So there are multiple ways and in which we can do a relationship with OEM, including for their export in some of the geographies. With some OEMs, we are also doing a lot of export for them. Wherever they are exporting their vehicles, we are exporting lubricants on their behalf. So there are multifaceted sort of relationship with various OEMs. And obviously, we are very happy that none of the OEM once associated with Gulf Oil has ever broken the partnership. All have been quite satisfying relationship at both ends. And obviously, we have been not only giving them a quality product, but also a fantastic service to cater to their network and to the aftermarket, which gives a win-win situation or creates a win-win for both. And that's how we have the highest number of OEMs in the industry today in terms of lubricant play. And we are associated with more than 40 OEMs across various product categories or vehicle categories and industrial. So yeah, very satisfying relationship with OEMs, I can say.
Okay, and given that you've looked at a segment-wise approach, that's B2B as well as the industrial segment, and both are expected to drive growth down the line, while you are looking at balancing volume growth as well as value. So how are you looking at this really shaping up in the long haul?
So we have a very strong presence in the aftermarket with what is called Bazaar market. We are a number two player there, and we want to continue to grow that double the market rate in terms of growth, and that has been a key margin driver also for us. We are catering to this Bazaar segment through our 300 plus distributors, automotive distributors, which in turn are catering to more than 85,000 retail touchpoints across India, in urban and semi-urban India. Plus, we are penetrating into rural in that market through our Gulf Rural Stockist concept, which we introduced 3-4 years ago. And we have more than 1,000 of such Gulf Rural Stockists now, which are working with us. And they are in turn catering to 10-15 retail outlets in their rural area. So overall, another 10-15,000 touch points for us. At the same time, on the industrial side, we have been relatively having lower market share, and that's an opportunity of high growth for us in terms of volume and value. As we know that India is going towards Make in India concept, and manufacturing push is being now focused on by the government. So with that, we hope that industrial piece of the lubricant market will also grow very fast, and we want to obviously be increasing our market share there very, very rapidly. So that's another key focus area where we are industrially in the industrial segment. We are not only introducing new products, getting more and more customer acquisition. We have, using digital and IT technology, we have implemented Salesforce for our B2B teams across India. So as to track their, customer acquisition journey. With all those help, we believe that both B2C and B2B segments for us are of equal focus, if not more, from one another. And we want to grow in both the segments at minimum towards the market growth rate.
So tell us about the battery performance. Do you believe that battery business, which has been seeing pretty strong volume growth and is on track to break even, it's going to continue to show this kind of a performance?
See, battery business was started by us. We only do motorcycle batteries or two-wheeler batteries, I would say. And the objective behind that was to use the synergy of distribution between lubricant and two-wheeler batteries. We launched VRLA batteries, which are maintenance-free batteries, in the market. And in the past, we have been importing these batteries and selling in Indian market. Now we have started localizing the production with some of our contract manufacturers, and we hope that this business will grow, because during post COVID and because of the supply chain disturbances from China, there was a sort of some downward impact on the volumes, but we have caught up in the last year and in the current year as we speak, and we intend to grow this volume and business to a 200 crore, 250 crore top line in the next 3-4 years, so that it becomes a meaningful pillar of our product portfolio and journey.
A little bit more about the foray into the electric vehicle charging. You've got plans to really double Tyrex's turnover annually over the next 3 to 4 years. What are you targeting by way of revenue for this segment over the next 3 to 5 years?
So I think, EV charging and EV charger manufacturing is a key focus area going forward for the company. And as you have rightly mentioned, we have invested into few companies already in that segment. We first invested in a company called Indra Technology, which is a UK-based company, where from India balance sheet, of course, we did 7.5% stake, and globally now Gulf International, our parent company, controls the Indra Technology. They manufacture AC slow chargers mainly for home application and car segment. And their product is very well established in the UK market, reaching already to more than 20,000 homes. And that product AC charge category is very good category for Indian market also. But we have been working with Indra Technology team for slightly making it more suitable to the Indian market in terms of not only technology, also price point, and then we can launch those products into India. At the same time, in Indian market, we were looking for opportunities, and we acquired a 51% stake in a company called Tyrex Transmission. They are specialized in DC fast charger manufacturing. So we have Indra AC chargers and Tyrex DC chargers now, which are fast chargers. So we have completed our product portfolio in terms of chargers. And Tyrex, as you mentioned rightly, is doing well. They have been focusing on fast charger, and they have 8 to 10% market share in the fast charger market in India today, working with many OEMs, including bus OEMs and PSU companies, which are putting chargers in their fuel stations, with many CPOs, which are who are currently trying to develop a charging infrastructure in the country on highways and in cities. So it's a fantastic portfolio to have. We believe that Gulf as a brand is a very well-known brand, known to the auto consumers. And if the consumer, which is today buying an ICE vehicle, tomorrow buys an EV vehicle also, Gulf as a brand should remain relevant to those consumers. And that's where the journey started in terms of looking at charger manufacturing. And these are businesses which are currently, though, very nascent and growing, but hold a very good future in the next 4 to 5 years. We want to, in Tyrex, we want to double the turnover every year at least going forward, or grow at a very healthy pace to make it a nearly 500 crore top line business in next 4 to 5 years. That's the aim, and it will become a very meaningful path point of our growth journey going forward.
And if we were to touch upon your financials as well, the fact that we have seen a fairly decent rise in the previous quarter in your net profits, how are you looking at your revenue run rate trajectory down the line? Can you just give us any ballpark figures to how you're expected to grow?
Same as we keep guiding our investors is that we want to continue to grow 2 to 3x the market growth rate in terms of volume. And as you know that lubricant industry volumes are growing at 3 to 4%. And we want to minimum grow 2x, which means that we will continue to gain market share for the coming many years. And we are preparing to not only get the market share plus also in a premium segment, how we can grow even faster. So lubricant wise, we are clearly looking at getting the market share while trying to improve our margins through premiumization, which has been our theme of Unlock 2.0, which we shared with our investor community in 2024, that we want to accelerate our growth, we want to premiumize, and we want to transform. In terms of volume growth, we want to continue to grow 2 to 3x and premiumize our portfolio by bringing in quality products, high quality products, and synthetic products. At the same time, transform, which is third leg of our Unlock 2.0, where we want to do current business in a more digitized way, and a lot of initiatives in the digital fields have been taken. As I mentioned, we have not only implemented Salesforce, we are significantly putting resources and budgets into digitizing our B2C businesses in terms of reaching to mechanics, in terms of reaching to retailers, and trying to create dashboards and data lakes within the company for a meaningful analytics. And with those analytics, we are quite sure that with the power of our brand and distribution reach, which we can create through digitization, we can definitely continue to gain market share in B2C space. And in B2B, the customer experience on these digitization efforts will be at a different level. So digitization in terms of transformation is a key focus area internally. And as I mentioned, digital transformation by way of becoming an EV charger manufacturer company to begin with, and play a relevant role in the EV field, where, as we know, that lubricant market is going to continue to grow in India for the next many decades. But there will be certain percentage of EVs which will come in certain segments, and that also needs to be catered. And our journey towards contributing to that EV infrastructure by way of becoming a charger manufacturer also will pave the way for companies' growth in the coming periods.
Right, and give us a sense as well as to what the outlook is, because you're really looking to achieve double-digit revenue growth down the line. What will that be supported by? You're looking at a lot of strategies to really enhance some of your segments and your product mixes. So what's the plan?
So I have already alluded that our focus remains to grow profitably towards the market minimum, both in terms of top line and in terms of obviously bottom line. We are currently in the EBITDA margin band of 12 to 14%. We want to strengthen that band, move towards the higher trajectory of the band, and then eventually over a period of next 2 to 3 years, move to the next higher bands of 14 to 16% and thereafter. To keep this happening, as I mentioned, we are working on multiple areas by bringing in not only new products, but also continuing to grow our distribution, which is a key in B2C in terms of reach. Our brand is already number 2 brand in the private sector. And if we can continue to grow our distribution by 10 to 15% in the B2C market, there is no reason why we should not be growing towards the market. And that's the aim. And internally, we are aiming for that. With the operating leverage coming in from the financial side after reaching a certain size and scale, you don't end up increasing your fixed cost with every new liter sold, and that's where the operating leverage will also start kicking in and will give us that additional delta at the EBITDA level, which will help us to improve EBITDA faster than the volume growth or more than the volume growth. So that's the clear plan. And whatever we are investing in the EV side, our investments with Tyrex at 51% investment already, we've started consolidating those results also in our numbers. And we believe that the consolidated number growth will be much higher than the standalone growth also, because Tyrex will continue to grow much faster, being at a low base currently.
Right, thank you so much for joining in. Been very interesting talking to you and understanding more about Gulf Oil Lubricants.
Thank you so much.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from Nirmal Bang.